Warren Buffett just made the most dramatic defensive move of his 60-year investing career. He's stockpiled a record-breaking $325 billion in cash, dumped significant portions of his favorite stocks, and is sending a clear warning that we're heading into something far worse than 2008. The Oracle of Omaha's actions are screaming that an unprecedented crisis is about to unfold. Let me show you the shocking evidence behind Buffett's warning. Warren Buffett's Berkshire Hathaway is currently sitting on an almost unfathomable $325 billion in cash, the highest level in the company's history. This isn't just another routine financial move, it's a deafening alarm bell. To put this figure into perspective, Berkshire's cash pile is now larger than the GDP of entire nations and exceeds the combined market value of corporate giants like Coca-Cola and Disney. But here's what's truly shocking. This cash reserve is nearly 6 times larger than what Berkshire held during the 2008 financial crisis. Think about that for a moment. Buffett, known for his love of buying and holding great businesses, is now holding more cash than ever before in his 60-year investing career. To understand the gravity of this situation, we need to look at Buffett's historical approach to cash management. He's always believed in maintaining a solid cash reserve, his famous safety net. But this isn't just about playing it safe. It's about being ready to strike when opportunities arise. We've seen this strategy play out before, most notably during the dot-com bubble and the 2008 financial crisis. Both times, Buffett's patience and cash positioning allowed him to make some of his most profitable investments ever. But this time is different. The scale of his defensive positioning is unprecedented. When you combine this massive cash pile with his recent selling actions, one thing becomes crystal clear. Buffett isn't just being cautious, he's preparing for something potentially catastrophic. What makes this situation even more alarming is Buffett's recent selling spree. He's been aggressively reducing positions in some of his favorite long-term holdings, including a shocking 20% reduction in both Apple and Bank of America, 2 companies he's consistently praised and held as crown jewels in Berkshire's portfolio. This is particularly significant because Buffett is famous for saying his favorite holding period is forever. When a long-term investor like Buffett starts selling his beloved positions at this scale, it's not just portfolio rebalancing, it's a warning sign of seismic proportions. But here's where things get really interesting and, frankly, terrifying. Buffett's moves align perfectly with an unprecedented crisis brewing in the commercial real estate market. We're facing a staggering $2.7 trillion in commercial real estate debt that's coming due within the next 20 months. This isn't just another market cycle. This is a mathematical impossibility that's about to explode. Let me break down why this situation is 100 times worse than 2008. Most of this debt was originated when interest rates were between 2% and 3% during an era of historically cheap money. Now, these loans need to be refinanced at around 7%. Let me show you exactly why this is a mathematical disaster waiting to happen. Imagine a $100 million commercial property financed at 3.5% interest. The annual interest payment was $3.5 million, with the property generating $5 million in net operating income, a perfectly sustainable investment with healthy cash flow margins. Fast forward to today at 7% interest, that same loan now requires $7 million in annual interest payments alone. But here's the critical part that most people are missing. The property's income hasn't doubled just because interest rates did. It's still only generating $5 million in income, meaning it's now underwater by $2 million annually. And that's before we even consider principal payments or operating expenses. This isn't just a problem for commercial real estate investors. It's a systematic crisis that could trigger a financial avalanche far worse than 2008. Here's why. Regional banks hold approximately 68% of all commercial real estate loans. These aren't the giant Wall Street banks that got bailed out in 2008. These are the local and regional banks that serve as the backbone of America's financial system. When these properties start defaulting, and the math shows many of them will, it won't just affect the real estate market. It will create a banking crisis that could make the 2008 financial crisis look like a minor hiccup. This is exactly what Warren Buffett sees coming, and it explains his recent moves to significantly reduce his position in banking stocks, including Bank of America. But there's another crucial piece of evidence that's setting off alarm bells in Omaha: the famous Buffett indicator, which compares the total value of U.S. stock market to the country's GDP, is flashing red at levels we've never seen before. Currently sitting at a staggering 208%, this crucial indicator isn't just high, it's in uncharted territory. To put this into perspective, during the infamous dot-com bubble of 2000, which ended in one of the most devastating market crashes in recent history, the indicator reached what was then considered an alarming level of 140%. Even during the 2008 financial crisis, it only touched 110%. Today's reading of 208% doesn't just surpass these previous danger zone, it absolutely dwarfs them. What makes this situation truly unprecedented is the convergence of multiple crises simultaneously. We're not just facing a commercial real estate crisis or a banking crisis or a stock market bubble. We're facing all of them at once. And unlike 2008, the Federal Reserve's tools to fight this crisis are severely limited. Here's why. Inflation remains stubbornly high, with interest rates at levels we haven't seen in decades. The Fed can't simply slash rates to zero and print money like they did in 2008 without risking runaway inflation. They're trapped between a rock and a hard place, and Buffett knows it. The regional banking crisis we saw earlier this year with Silicon Valley Bank and First Republic was just the tip of the iceberg. The real crisis is still brewing beneath the surface. Regional banks are sitting on massive unrealized losses in their bond portfolios due to rising interest rates. And now they're about to face a tsunami of commercial real estate defaults. This explains why Buffett has been systematically reducing his exposure to the banking sector. He's not just trimming his positions, he's preparing for what could be the biggest banking crisis in American history. When you combine the unrealized losses in bank bond portfolios with the coming wave of commercial real estate defaults, you're looking at a potential crisis that could dwarf 2008. The commercial real estate crisis won't stay contained to just office buildings and shopping malls. It's already starting to spill over into the residential real estate market. Here's how. As regional banks face mounting losses from commercial real estate, they're tightening lending standards across all sectors, including residential mortgages. This credit crunch is happening just as mortgage rates have soared above 7%, the highest level in decades. The combination of tight credit and high rates is already causing the biggest collapse in homebuyer demand ever recorded in American history. Mortgage applications have plummeted 63% from their pandemic peak, a decline that makes the 2008 housing crisis look mild in comparison. But perhaps the most alarming signal of all is coming from the U.S. Treasury market. Buffett now holds more Treasury bills than the federal government itself, an unprecedented position that speaks volumes about what he sees coming. This isn't just about seeking safety. It's about preparing for what could be the biggest market dislocation in modern history. To truly understand why Buffett's current moves are so significant, we need to look at his track record during previous market turning points. Throughout his 60-year investing career, Buffett has made similarly defensive moves only a handful of times, and each instance preceded a significant market correction. Let's travel back to the late 1990s during the height of the dot-com bubble. While most investors were caught up in the tech stock frenzy, Buffett faced intense criticism for refusing to participate in the new economy stocks. Instead, he steadily built up his cash reserves and stuck to his value investing principles. When the bubble burst in 2000, his patience was vindicated as tech-heavy portfolios were devastated, while Berkshire's conservative positioning allowed it to capitalize on the opportunities that emerged. The 2008 financial crisis provides another telling example. Leading up to the crisis, Berkshire had accumulated a $44 billion cash reserve, a figure that seemed excessive to many at the time. But when the financial system began to crumble, this cash pile transformed from a drag on returns into a powerful weapon. While others were forced to sell at fire sale prices, Buffett was able to strike legendary deals, including a $5 billion investment in Goldman Sachs that generated billions in profits. But here's what's truly alarming. Buffett's current defensive positioning is far more extreme than during either of these previous crises. His cash reserves are substantially larger, his selling activity is more pronounced, and his warnings are more explicit than we've ever seen before. For those watching this video, let me break down the crucial warning signs that could signal the beginning of this massive financial shift. First and foremost, keep a close eye on regional banks, particularly those heavily exposed to commercial real estate. These institutions are the canaries in the coal mine. Any significant increase in their loan loss provisions or deterioration in their commercial real estate portfolios isn't just a local problem. It's likely the first domino in a much larger cascade. The commercial real estate market itself is sending alarming signals that demand our attention. We're already seeing a surge in commercial mortgage delinquency rates, especially in office and retail properties. This isn't surprising when you consider that the first wave of that massive $2.7 trillion in maturing debt is already hitting the market, and the defaults are beginning to mount. What we're seeing now is just the tip of the iceberg. Perhaps even more concerning is the rapid tightening of credit markets. As regional banks face mounting losses, they're pulling back hard on lending. This isn't just about making it harder to get a loan. It's about a fundamental shift in how money flows through our economy. This credit tightening creates a dangerous feedback loop. As banks restrict lending, businesses struggle to refinance their debt, leading to more defaults, which causes banks to tighten even further. Finally, and this is crucial, watch the Treasury market like a hawk. Any unusual volatility here isn't just about government bonds. It's a symptom of deep stress in our financial system. What makes this particularly worrying is that the Treasury market is supposed to be the bedrock of financial stability. When we see significant disruptions here, it often precedes a broader market crisis. This is exactly why Buffett has moved so heavily into Treasuries. He's preparing for the storm he sees coming. What we're witnessing isn't just another market cycle. The convergence of a massive commercial real estate crisis, a vulnerable banking system, record-high market valuations, and limited Fed options creates a perfect storm that could make 2008 look mild in comparison. Warren Buffett's unprecedented defensive moves are sending us a clear warning. Get ready for what could be the biggest financial crisis of our lifetime. The mathematics of the situation is undeniable, and the dominoes are already beginning to fall. The question isn't if this crisis will unfold, but when. And more importantly, whether you'll be prepared when it does. The time to act is now, before the full extent of this crisis becomes apparent to everyone. What do you think about Buffett's warning signals? Are you taking steps to prepare for what's coming? Let me know in the comments below, and don't forget to subscribe to the channel.